members, fellow members here, and fellow IPs and other professionals here. Uh, Yesterday, also, we had another speaker speaking on the haircut, rising haircut topic. So I have assumed, since the topic yesterday was rising haircuts and its relevance, today's topic, I'm just keeping it slightly different on assumption of what may have been dealt with yesterday. How the haircuts affects the economy, whether it has impact on valuation or not. If I'm not audible, please let me know. And whether there is a direct linear correlation between haircut and the liquidation value, and how does it impact? So to do that, what I have done is I have structured my presentation so that I show the correlation between how a commercial bank works in a very simple terms. How does it impact the economy? What happens when haircut is taken by a bank? How does that impact the economy? What are the key points for valuation? What are the key points for haircut? And where does that correlation go? And certain case laws, which in the early days, uh, certain jurisprudence were set in terms of haircut, even though the grounds were compelling or the reason given in those applications were quite, what should I say, uh, compelling or very, hard hitting. In spite of that, the judgments that came. So we will deal with it. Let me start sharing my screen so that I take the fellow professionals here. So as you know, the topic is impact of haircut on Indian economy and liquidation value. This workshop is being organized by Institute of Company Secretaries of India, the IP of it. Now, the flow of discussion that I've kept here is what is the impact of banking on economy? So I'll try and explain in a couple of slides in the beginning. What are the key points for haircut? What it means? How does it impact? And next is, does it have any impact on liquidation value? And certain case laws, which in my opinion, these were relevant for today's topic. And early days, they set certain precedent for any kind of litigation on haircuts. Possibly I have cited, and then we will have question answer sessions. I'll try and take you through. Let's start with how does a commercial bank functions, not in terms of the banking transaction and how a bank functions, but for economy. So what are the role? And I've used use the word commercial bank, there are different banks, bank or specialized bank for say housing loans or ARCs or stressed asset banks. But in general, the lending is done by commercial banks. So I'm just restricting or narrowing it down the discussion only to commercial banks. So what in a very holistic perspective, what does a commercial bank do? I'm just reiterating certain points which you may all know. However, make the whole discussion lucid and flowing. Let's look at it. Impact of a commercial bank. First, according to in a very holistic manner, first thing that a commercial bank or a bank does is handling of financial asset in simplistic terms. What it does is it allows prospective customer to become a customer by opening an account as they are called account holders. So the first thing it does handling of financial assets is handle the money which has been deposited by the customer or account holders. At the same time, it also ensures there is always adequate money kept in the whole banking system of our bank or many banks individually keep adequate amount of money for withdrawals. Otherwise, if one person is not able to withdraw money, there is a run on the bank. And we have seen this happening for may not be very legitimate reason, but more sentimental reasons. We have seen this happening in India and we have read about it globally. The third one is once the monies have been deposited by holders in a bank account, in the process of handling the asset, you also ensure the timely disposal of interest and ensure why the financial asset creation or handling of the financial asset, there is sufficient funds that is available in the bank. When you put together many banks in the banking system, sufficient funds for loans and other debt products. Because let's take 20 seconds or 30 seconds pause here and discuss how does because every business economy grows through a commercial structure. The economy does not grow on sentiment or any other reason. The growth in economy today globally is purely commercial, trade and commerce determined whether a particular economy or the global economy is growing or not. And every trade and commerce would need sufficient risk capital, growth capital, or sustenance capital, which are funded through various means, various kinds of commercial lending mechanism, either through a bank or private equity, arms of the bank, venture capital funds, and the plain vanilla products that we are very used to, term loans, WCD, LCC, overdraft, all that happens. So we keep doing that. The next one, according to me, from an economy point of view, is capital formation. And we will link this with money creation as we go along the presentation and the discussion. So, and we will see when I take out a very simple example, what it does in the process of capital formation. Whatever money that has been deposited, that is treated as a lending capital. We will see the terms, etc., as we progress. And what it does with this capital, it deploys it. I have used the word investment. Investment here means investment into certain product or investment into lending product. So a bank uses or utilizes the deposit that has been given for making investment which will give the bank the maximum returns possible under any economic environment, and use this earning to pay interest and ensure earning for the deposit holder whose money it is treating as capital. And you will see how this capital formation works as we progress. The third point, that from an economy point of view, it promotes savings. Now, 2 points before I start explaining what I've written here. One needs to understand that in an economy, that savings by its general citizen, and two, spending by its citizens. It may sound as a bit of dichotomy, but barring certain exceptions, I would not, on this count, I would not take America as an example, but other countries which have a good capital formation and then deployment of that capital in spurring the growth has higher saving rate, anywhere to the best of my knowledge, 23 to 29%. India, some years back, used to have 23, 24% as the saving rate, which is good. So what a bank does, it perceptibly, not legally or arguably, perception-wise, a bank creates a sense of safe harbor for its earning money in every ordinary user of banking facility or a citizen. If I'm earning money, if it is in bank, if it is in FD of bank, not any other instrument in the market, that general perception is safer. And what happens, because of the safety and stability that people need, because one is safety, perception of safety. The second is also, since most of it investment that happens in a bank from an ordinary account holder is in the form of a debt, which means either you create FDs or you leave it in your saving account generally, and you get a fixed return. So two things usually perceived as, yes, my money is safe and I get a fixed return. So a sense of stability in return and sense of stability and safety applies. And that kind of prompts people to save more or keep more money into the bank, which in turn helps increase the deposits bank. The larger the deposits a bank has, the larger its ability to lend and multiply. We'll see those as we go to the example. The next one is, it meets a crucial need, as I explained in the last two slides, that every business, depending on where it is in its life cycle, so a startup needs risk capital. Banks may not lend, some other people lend, angel investors, private equity, venture capital funds. They try and help you here in terms of risk capital. But when you need money to grow asset and expand your business in terms of buying asset, creating asset, or buying companies, not equities of the company, but buying business, the term loans and debt funds given by lending by the bank comes into play, and it gives you that way. If you need to improve your business, need working capital, the bank steps in and gives you a loan. And there are various MSME loan, and there are various, like we had COVID time guaranteed funds also, various kind of products that are there, which help business to grow the economy. India, a significant quantum of population depends on agriculture, even today. It helps farmer by providing agriculture lending so that they are able to invest in their agriculture and generate a good agriculture, of course, dependent on many other factors like monsoon, etc., and the pricing set. But it helps your rural economy. If the agriculture is good, the demand and the general spending in the rural sector, as well as the saving, grows, and which in turn aids a big way in the growth of the economy. And of course, various other lending products for professionals, salaried people, any ordinary citizen who has a banking account and who fits the eligibility criteria for products that the bank bring in, personal loans, credit cards, etc. That gives, and that also helps. And how does it help? It enhances consumer spending. Because just to give you two, three examples, very simple one, and it's each one of us have done it once, twice, thrice, many times, consciously or compulsively, whichever way. Today, I have to send my child to college. I don't have the money. What do I do? To ensure that my children gets the education, there is no interruption in his studies. I go to a bank, take educational loan, which includes a decent portion towards his living expenses or her living expenses. Also, ensure there is a loan, there is a backup, whether I have enough savings or not, my child gets education. So, and when my children spend on education, it helps to, I'm building the talent capital of the country, as well as the spending that I'm doing today spurs growth in educational institution, as well as other commodities that is being used in that process. Similarly, education loans, car loans, home loans, all these spendings, if more people buy homes, there is a growth in real estate sector. More people start buying consumer goods, so electronics and white goods industries see a growth. So likewise, and in turn, the increased spending drives demand in economy. As a cycle, higher the spending, higher the demand, impels the specific sectors or general economy, higher manufacturing or higher creation of capacity as well as production or accumulation of services, which in turn gives more employment. And it's a cycle which helps the economy to keep funding. It also helps promote trade and aid development. So if you have a bank near your business, it's easier for you to deal. And we have taken it for granted, especially in metros, Tier 1 cities, large centers, that wherever we are, there will be a bank around. And a lot of products, if I want to safely do an export, there is a complete banking channel. 30 years back, it was very difficult. Before liberalization, there was so many restrictions. It was very difficult to do any kind of export. Used to be it had a lot longer time to do anything. And today, even domestic trade can be done on LC. So you're very sure of your payment. There are no uncertainties. It allows you not only to do business, impact, improve your growth. It also helps you, generate money against your invoicing. There are various products, trade finance, which helps you make your business more efficient and grow it. And the larger the spread of these banking facilities in Tier 2, Tier 3, semi-urban, rural areas, the more help it has. See, I'll just give you an example, which will, in the last 10, 12 years, we have seen a tremendous growth in rural. Two key things. What has happened is the Jan Dhan Yojana that made the whole country we were able to open roughly 35 to 45 million bank accounts, which help any benefit to be given to the people who are eligible for it directly to be credited to their account. And today, you know, I've seen this happening even in states like Orissa, Bihar, which are relatively less developed than, or UP, many parts of UP, which are less developed than some of the western and southern counterparts. 15 years back, or I'll go a little more, you didn't find many pakka houses. There are different reasons for pakka houses coming, but banking and the reach of banking is one of the important chain there, because Jan Dhan Yojana helped them receive PM Awas Yojana or whatever Chief Minister's Awas Yojana help that was to be coming directly credited to their bank. And most of the houses that I see, even in remote villages, are pakka. There are concrete roads reaching to most of the villages. So the development has happened not only because of banking. Banking has helped them use and develop. Well, how did people get pakka houses? Because of the banking. People's ability to draw on the schemes and use that money and not run around to collectorate and treasury to take that money out in cash helps further growth. Because all I have to do is one-time activity, take whatever signature from here, from Tehsil, whatever, and once I'm declared eligible, the flow of money does not take equal or more time. It happens faster, much faster. And that allows me to utilize that facility. If I'm working the Manrega scheme, my money comes immediately or very fast into my account. So this expansion of banking into rural area, semi-urban areas have helped trade. I know certain farmers who were selling or just giving their produce, say in mango growing areas. They were just giving it away to any trader who came, because it's very difficult for them to of course, logistics and other facilities also improved. But since the banking and the trade instruments were not there, trade finance instruments were not there, they're finding it difficult. So today what they do is they, because of the improved logistics, they take it this money, but however, they also sell it to export houses against IBC. So their payments are not come. So farmers sitting in village are able to utilize banking channel to get better return on their produce. Maybe today only a small portion or 20-30% of we are able to do. Tomorrow, I assume, as the growth and expansion of banking facilities and digitalization keeps happening, it'll happen quite fast. Okay. Now, let's step into how does the bank also help in creating money and helping the central bank and the government key monetary policies, how bank becomes important there, and it affects the economy either way. So the banks are mandated to hold on to reserve and not lend out of certain portion of their deposits. And these reserves can either be form of cash, securities, or certain securities which can be quickly converted to cash. Of course, the amount of reserve depends on bank's assessment of its depositors' need of cash, and there are certain regulatory requirements in our country. Typically, the central bank of every country in our country, RBI, which issues policies and dictats in terms of how they should go about. Let's see. Now, what as we have seen earlier, bank lends the money given by the depositor. The money can be used, whatever loans that is given to the party for purchase of goods and services by the person who has taken the loan, who could be different from the person who has deposited. What happens when they buy goods or services, or whenever they use the loan for the purpose that they have taken, that money kind of circle back into the banking system, either same bank or another bank, in the form of deposit or in the form of a balance, a current account, etc. And whatever comes in the form of deposit, a fraction of it can be lent. So what happens, the same money, 100 rupees lent out, comes back, 20 rupees comes back in deposit. So the earlier 100 rupees, which was lent out against 130 rupees, because 130 rupees was the deposit, that 20 makes it 150. Against 100, maybe 110 can be lent. So this is how the money creation happens and the process of multiplier effect. I'll just explain it with a simple example going forward. Before that, we quickly discuss what do the bank also do. The bank also plays a central role in transmission of monetary policy, which is one of the government's most important tool for either achievement of economic growth or controlling inflation, etc., etc. The central bank, the central bank does it by various means. One of the means is raising the interest rate. A higher interest rate implies or results into lesser borrowing. So the money circulating in the economy kind of stays back or gets sucked back into the banking system. So money circulating in the economy reduces, which in a simplistic economist view, the money chasing goods and services from X becomes X minus something, and which in turn helps cool down the inflation a little because demand reduces. So if I had 100 rupees and if my EMI goes up, then the surplus in my hand from 100 rupees may become 60 rupees because higher interest is sucked away 40 rupees from my pocket. So earlier I was looking to buy two things using the 100 rupees that surplus I perceived would remain in my hand. I have only 60, so I'm going to buy only one thing. So the second thing that I wanted to buy goes out of my radar. So one person demanding that particular product goes down. So similarly, what happens when, in general, people like me in crores, when they're impacted, the overall demand for certain sectors or in general, every sector would come down because there is lesser money in hands of people or in economy, which means lesser money is chasing same quantum of goods. It brings down the inflation, which means the high demand creates higher price points, and that takes away, that increases the price of the goods, which results in inflation. Lower demand suppresses that a little, so that inflation. So that's one of the key tools which happens. All this has a relevant, extremely important relevance to our this thing when we are talking about haircut. We'll come to it. Let's understand how this impacts us. And just to add to what I was speaking, when banks can shrink the money supply and reduce their holding, what happens? It can lead to a credit crunch. Sometimes it may be desirable, sometimes it may not be desirable. That's something not so relevant to our topic here. I'll not dwell on that. Hmm. Now let's see haircut. We'll come back to money creation and impact on economy. How do we define haircut? In simple terms, if I were to read, it's a term applicable when a debtor faces difficulty in recovering his debt. In the case of a bankruptcy proceeding, it is a proportionate reduction in the debt that will be paid to creditors based on an evaluation of total debt owed versus the total debt of the debtor, total assets of the debtor. Now, to put it simply, if as a bank I have given 20 crores loan to a corporate debtor which is undergoing a corporate insolvency resolution process, and the assets of the bank allow recovery of only 12 crores and 15 crores in totality, which means the potential resolution applicant sees only a value of 12 or 15 crores in the assets of the company, and through its proposed scheme, it says we will pay only 12 crores to the secured creditor, 3 crores towards all other. And the COC accepts that proposal. It is compliant with 30 subsection 2, read with 53, then which means the bank is able to recover against 20 crores only 12 crores. So it has suffered 40% haircut. That's what it means. And in terms of loan recovery, I'm just repeating that. Why haircut is necessitated? In the profession or in the professional setup that we are speaking, I doubt anything comes without a haircut here. So each and every case would see a haircut because we are dealing with stressed assets. Only when things are not right, then they knock at the doorsteps of insolvency, including restructuring, case file and withdrawal. Everybody's facing the stress, and that's why they start knocking at our door. And it is the difference between what is the actual due and what they have got. And invariably, lenders use haircut as a last resort of recovery. Even though IBC, many judgment is very clearly said, it's not a law for recovery. But quite a few creditors, especially operational creditors, operational creditors use it as a recovery tool. Even if you look at back lenders, haircuts is a last resort. They would try their level best to recover the interest and the principal portion, because in the banking books, the day an asset is classified or a loan is classified as NPA, the interest and the meter stops. There may be a memorandum calculation, but actually there is no interest that is shown in the ledger of that particular loan account. So usually their interest is to, let's do strategy, recover adequately, let's recover this, and there is no haircut. So a lender or a bank would try every means that's possible to quickly recover its dues. When it is not able to recover its full due, then they start looking at haircut, maybe one-time settlement, maybe whatever settlement that can possibly happen. and nothing works, then they realize that it is a fit case for insolvency, then insolvency filing. The older an asset is, and we have seen, I need not, it's not a new thing, each one of you know this, that many of the cases or most of the cases that we have seen coming to insolvency proceeding are assets which had become NPA some time back. The plants are closed, different recovery procedures, different recovery instruments or laws were being tried. And sometimes after 2 years, 3 years, of course, where they're hit by limitation, they are not able to proceed. But we had discussed the topic of limitation also a couple of months back, or a month and a half back here. So they come. So usually we see there is a decent amount of gap between a loan account or an asset getting classified as NPA, and it is brought to an application being filed. That is the first gap. The second gap that happens most of the time is if an application is made today, after all defects, etc., are clear, it takes quite a bit of time. Sometimes, in my experience, nowadays I've seen only cases where the consents were given in 1920 being admitted. I mean, I'm speaking from a smaller population because I haven't dived into the data of IBBI to look at where the averages are in this particular aspect. But it takes reasonable time once application is filed from the admittance. So the possibility of haircut, according to me, is almost 99%. I haven't come across a single case. I'm just leaving that 1% room if something may happen in the future. But I haven't seen a single case where haircut does not happen or has not happened. There may be case where the lenders have got full money, but the operational creditors, statutory authorities, government dues have faced haircut. Unsecured financial creditors have faced haircut. Secured creditors, in the order of priority, get hit the least comparatively. So all the cases do suffer, in my experience and my understanding of the cases, that so far every case suffers haircut. Now let's understand the money creation and the implication of haircut, how they are interrelated. As I earlier shared, RBI mandates that banks must maintain two kinds of reserves: a cash reserve and a statutory liquidity reserve clubbed with high quality liquid, HQLA. RBI has mandated 4% and 8.2% as the minimum for CRR and SLR. HQLA is something which needs to cover 30 days of expected cash flow. There is no fixed percentage to it. It is dynamic and the banks have to make assessment accordingly. So safer, what we do is, if we have to deal with it, what we assume is SLR and HQLA put together 23% is something which generally taken. So here we see these are the two reserves that they have to do. Now let's look at very, very simple. Our kids, a balance sheet written by a kid for a bank. Let's see that way. So what we are saying, the capital of bank is rupees 13. The client deposits, etc., is 130 rupees, which is NDT, which allows, that is what can be the kitty from which the lending can happen. Saying CRR, they have kept 8, these SLR, etc., is 35. They have lent out. So against a total fund of 143, they have lent out 100. Okay, how does it play? Now let's look at, there is demand and time deposit, 130 as we saw, 13 rupees is capital. Funding or lending is done for 100 rupees. And how do we work out this? Say, what it needs to maintain against 130 is for CRR a 5.2 and for SLR 29.9 against 130. If we take 23% and 4%, total 27% is what they need to maintain. Looking at the balance sheet where we have seen that towards the reserve, there is an amount of 43, which means the minimum that the bank is supposed to keep is an amount of 35.1, which is 27% of 150. So the balance sheet has a surplus of 7.9, which can be further used for lending. Now, if a customer comes which requires 15 rupees loan, the surplus is only 7.9. Can the bank lend to the new client or not? Theoretically, looking at, you may say no, but that's where the beauty of money creation, banking and money creation comes in. Because as I spoke earlier, the bank gives a loan and it credits as to the account of borrower. The borrower deploys the funds and that money goes into a beneficiary account. Assume that beneficiary account is in this bank only. For ease of understanding, let's assume, so 7.9 is the first bank that they lend. Out of 7.9, 4 comes back. Since the lending has gone up to 108, and out of that money, 4.5 comes back, that 4.5, after reducing 27%, can further be deployed because that came back as deposit, it will add to 130. And this will keep merry-go round or circle. This cycle will keep repeating. This is a multiplier system. And that's how the multiplication or creation of money happens and the banks are able to lend. What are the constraints? We have seen constraint in terms of CRR, SLR. So from the previous example, whatever deposit they take, this 27% is sacrosanct. You can't touch it. This has to have in the way, in type of instruments, in method of holding, as the RBI dictates, the bank will have to keep it. There is another one, which is known as CAR, which is capital adequacy ratio. If one were to look at Basel III norms, which are prevalent for guidelines for today's international banking, it says 8% of your time deposit lending that you're doing have to be minimum kept. RBI, in my understanding, for all scheduled commercial bank, all banks which are given license by RBI are scheduled commercial banks. So they have to keep 9%, and they have also given a specific mandate, the public sector bank, which have to do a lot of priority sector lending, government scheme lending, etc., without going into the reason why that directive is at 12%. See what happens. If the 100 rupees loan, assume that 100 rupee loan was given to a single client, and that client runs into stressful period, that asset becomes stressed. There are two ways the settlement of that loan account can happen. One is one time only cash, pay less than what is the actual due, and be done. Whatever is the haircut in that case, that haircut amount is to be provided for in a simplistic term. Of course, many of you who are banker would know that there are different steps under which it is done. But here it is straight away goes into reducing the capital. So what has to happen? The bank has to generate more money. It impacts its lending ability. So it could lend 100 against 143. If 143 goes down because the 10 rupees capital reduction happens, then it will, it has to reduce its lending. Or the government will have to come, if it's a public sector bank, and aid to what do you call as the making the capital adequacy ratio of the bank right. So haircuts impair banks' ability to be able to lend more because it reduces that or restricts that. So the ability to pump capital or push capital for further growth of businesses, further growth of agriculture, further growth of spending is starts taking a hit. If you recall, there was 135,000 crores few years back. The government had to budget so that the massive amount of provisioning and write-off against the stressed asset that the public sector bank had to do, their capital needed to be. So what happened? From one end, it went into RBI deposit. If this 135 crores had been given, even in tranches, say just to add to the national highway building budget, it would have generated more infrastructure, employment with people, and better logistics for the business to grow. So in a very, very 20,000 feet view, without adding complexity, we are not here to understand the complexity of the banking system, but we're just trying to correlate how does haircuts affect the economy. And I tried to keep it very, very simple. in terms of this is how the economy gets affected. There are multiple factors, and we can, if you wants discuss, they can discuss a lot of complex scenarios, complex methods. But in simple terms, the ability to create money, the ability to create, push capital or, provide capital for growth, facilitation of the business, sustenance of the business, that comes down to somebody, or like when my EMI goes up, my ability to buy two new goods come down. Similarly, if the bank is lending rare, if I need certain amount to add another, shed and put two more machinery for, say, I'm producing vessels, that is not available. So I'm not able to meet demand, or maybe I'm not able to produce more. And that's how it affects. If I don't produce more, and there is a timing gap between equalization of demand and supply, so inflation can go up, or it can create shortages. I mean, multiple things will happen, but it impacts the economy negatively. However, the silver lining we as insolvency professionals should see is, if an NPA, which we have seen in many cases, a sugar mill, surface done, 4 auctions done by bank, no buyer, not even buying in pieces of assets. However, after 8 years, the same sugar mill comes, and in insolvency, it has found a buyer, and the revival happens. Three things. One, in the meanwhile, when the bank was trying to sell that asset and recover its money, it had made provisions and taken the hit and reduced theoretically its capacity to create more money or lend capital. But because of the IBC process, it is able to make recovery, which means it straight away adds to the profitability of the bank, because earlier loans they have already been written off or provided for. So it's logical that this will simply add, because they have been charged against the profits of the company. Provision, write-off, both has the same impact. Of course, provision is the first hit, write-off is a final procedural takeout that happens in any balance sheet for income tax purposes and other regulatory purposes. But from an accounting and a financial statement perspective, make provision, your profit and loss account is taken. So the money that you generate, recoveries that the banks made, straight away goes to that. Second thing, a closed sugar mill, when it revives, of course, it will need additional capital, but it will give employment, assuming it's a 5,000, tons or 2,500 tons crushing capacity per day. Then it will need at least a couple of hundred people to run the plant. 100, 120 people. It will need farmer to supply the sugar cane. It may also help because the bagasse can be used for generation of electricity. And when you're doing the distillation, you will be able to take out ethanol also. So look at the chain. One revival, even though haircut happened, but one revival through IBC mechanism, the business revives in the whole area for a 2,500 TCD plant. There would be at least 2,000 to 3,000 farmers who will get means to supply the sugar canes to the factory which is nearer to them, because logistics costs are very high. It does not make sense that for a 1 ton of sugarcane, you instead of spending 250 rupees, you're spending 3,000 rupees, which is not viable. So you can't supply sugarcane to a factory which is 500 kilometers away. It gives employment to a few hundred people, and then electricity, it gets into the central grid, the state's grid or wherever it is. It helps accumulate the power requirement of that state. And ethanol, today, India is a large shortage of ethanol. The government is allowing 10%, 15%, 5 to 15% mixing of ethanol in the fuel of petrol or diesel. Which in a way helps governments if 5 to 10% mixture is also created, which means the governments need to import crude to that proportion reduced. Foreign exchange outflow preserved. Trade balance reduces. So it's a multiplying effect. I would say haircut in IBC should be seen as a positive thing, not as a negative thing, because with a haircut also, if we are able to revive as many companies as possible, that's the direct benefit to the economy. And it preserves so much of capital which went in by the promoter, goes waste otherwise. 100 crores to create a plant, and when it's liquidated, sold in scrap, you don't get much value for the land. The plant and machinery, which ate away close to 60, 70 crores, will fetch you a few crores. So all the capital which is employed is lost. Whereas here, it becomes productive. So that's what I've written here. Haircut reduces money creation, which in turn affects economy's growth. Now let's look, sorry for some funny images that I've used. How does it impact liquidation value? Now let's look at it. What are the key points one way to look at haircut? What are the key points comes? So haircut is a comparison against claims admitted. So if the bank has claimed 100 crores and that claim is admitted, any recovery is just a moment. Any recovery is taken as a percentage against that. The haircut also depends on when was the insolvency proceeding initiated. Was it after the asset was classified as NPA, after many years after the NPA classification, immediately, or in future we may see along with the NPA classification, there may be movements, because globally, in my understanding, what we call as PRP, which is a failed product in our insolvency system, globally, that is what is happening, debtor in control and restructuring insolvency proceeding happens. I'm talking about economies which have seen insolvency for the last 30, 35 years or plus, maybe US, UK, etc., where insolvency law has been there for many, many years, a few decades at least. So we may see NPA classification and insolvency proceeding happening, but as of now, today haircut is dependent on when the insolvency proceeding is initiated. Commencement, how many years after NPA, how many years, and the other factor which is equally important is the corporate debtor operationally a going concern. So if it is a real estate project, is the construction in continuation or it's a standstill? Because even if in a real estate sector, even if it is 40%, even if the superstructure is, which means pillars, slabs are done, including the wall, partition wall, in my understanding, it's only 40-45% of the whole work done. The finish and everything is remaining 50-55%. If it is 60% complete and at that point of time it has been halted and it has been lying there for 2-3 years, when you start the work on that project again, you don't start from 50 or 60% completion and when it is stopped. You will have to do at least 15 to 20% of the work redone. Plasters of the wall may have come off. One section comes off, there is always a possibility the other section. So you may have to do the whole wall. Tiles are broken, you may have to change quite a few of them. Pipes have gone bad, you may have to change the whole pipe. So if it is construction is continuing, in that case, the recovery from the asset would be much higher. Even in a manufacturing plant. If your rolling pins are working, your cranes are aligned in a vessel manufacturing plant. I'm just randomly taking example. Your cutters are fine, your welding machines are fine. Even if a non-sector buyer, which means somebody who is not interested or somebody who does not come from the same fabrication and vessel manufacturing background, still they may be able to value the plant and machinery much higher, even though their method or their business may be just lending such plants to any interested player who is not in a position to create a plant, who doesn't have that kind of money, who will lease plant and run it. So the value for this operational plants would be much higher than a plant which has been closed. Then everybody sees only the scrap value in your cranes, in your rolling pins, bending machines, welding machines. Aadhe kaam karte hain, aadhe nahi karte hain. And this is what happens, which in turn means the value of the asset goes down, the haircut goes up. Now, let's look at valuation. So what is valuation dependent on? The first thing that comes obviously to our mind is condition of asset, whether the unit is closed or running, whether it's a going concern or a closed concern. Market puts value differently on the same assets, on a closed as well as running. I'm talking about general. Second thing, valuation is a scientific, professionally assessed and based on established standards. A valuation process is done by professionals. There is a methodology. There are standards, international standards, under which they have to do the valuation. Third, the valuation is also market linked, subject to specific encumbrances. So let me quote two examples here. what I mean by the last one. First two are easy to understand. I think that I need to do a little bit of elaboration on the third one. A manufacturing concern running plant and machinery, shed and building in proper case. In one case, no encumbrance. Valuation methodology may remain same. So the land and building will be valued as per land and building. Shed will have a value. The land will have a value. Plant and machinery, you will be using the same method, income approach, cost approach, comparative approach, whatever approach the valuers want to adopt. It has to be within the same realm. The second case, plant and machinery is hypothecated and it can't be sold. Now, any buyer then knows that there is certain encumbrance on this asset, which will need payoff release from the banking system. So the end value of both the cases will be different. I'm talking about valuation. I'm not talking about secured, unsecured, this and that. Encumbrance could be a charge, could be hypothecation, could be anything. A conditionality or anything which can put an encumbrance. In a real estate, you could have fully paid land because the valuation of the land will be done as per the circle rate prevalent in that area or earlier assets sold in that area. And of course, it has to go to the circle rate. But one has certain encumbrances which says there is a joint development and without giving X portion of that finished unit, you will not be able to do anything with the land. Now, the value of land per square meter may be same, but the final valuation of the asset or realizable value of the asset would be different in both the cases. So that is where I mean to say market link subject to specific encumbrances. If it is fully paid, the valuation may be different. If it is not fully paid and encumbrances are there, then what of cost will be required to get the encumbrances out? How does market view similar kind of a thing? So that's where I meant to say. Now, in my opinion, some of my learned friends may have a different opinion among the audience, but in my opinion, haircut and valuation are, they don't have a linear correlation except one, which is the realizable value of the liquidation value of the asset is lower. Obviously, to that extent, the distribution to the entire gamut of stakeholder is going to be lower. So to that extent, there is a correlation, but is that correlation linear? In my understanding, may not be so. So let me try and exemplify this. Assume a company's liquidation value as an RP that you have been able to get from your valuers, put together, all of them is 100 crore. And the composition of creditors is secured, unsecured, statutory dues. It's there. Now, liquidation value and the distribution will be subject to encumbrances in terms of security. If 100 crore is the liquidation value and entire asset is charged to, say, the lead banker, so that lead banker becomes secure, you will end up satisfying the lead banker's liquidation value, because in case of default, you have to give the liquidation value to any creditor, financial creditor. So whatever is the value, the way one would calculate while looking at a resolution plan was what is the liquidation value of this asset. The whole 100 crore will have to go to the secure creditors whose claim maybe 200 crore. And in your calculation, the liquidation value towards unsecured creditors, financial creditors, or operational creditors will become zero, because the value of claims, financial creditors' claim, or secured financial creditor claims exceed the liquidation value of the company. So haircut is determined by these factors also. There is no linear population. If we were to change that slightly, 100 crore liquidation value, and there are 6 bankers who have security of 80 crores worth. In that case, the haircut, same company, slight change, haircut percentage would be different. In the first case, you'll have banker, secured banker, or secured financial creditor recovering 50, 60, 70% of its claim, and rest getting nothing. And COCs, for all its wisdom, are cutthroat. They look at their recovery first and then be generous. So if you are very clear, this is what my committees are allowing me, or they'll not be happy, then they want everything to themselves. If my committee has told me to take this much and leave a little bit, otherwise they'll not leave. So that's how it works. In the second case, 80 is the secured one. The recovery percentage, maybe 40%, maybe 50%, depending on how it is played, pari passu, first charge, second charge, etc., etc. And 20 crores possibly will remain towards unsecured financial creditors, operational creditors. So the haircut percentage has no linear correlation with valuation. Both the cases, valuation would remain the same, because it's a standardized, 60% standardized method. It's a scientific calculation based standard. Of course, a lot of professional judgment has to be done, but it can't be so much. That is why, if you look at your regulation also 35, it says if they're significant different, then you need a third valuer. So in practice, if the difference between two valuation is more than 15-20%, you immediately go and appoint a third valuer in that class. That is the reason. Now, the other point is, and I'll exemplify this one. So haircut is also decided by the buyer and the factor in a specific asset sector. So let me go back to my example when I said there is a manufacturing plant, a fabrication unit, manufactures vessels and fabricates engineering goods. If that unit, the prospective buyer is somebody who is in that space only, and they want to consolidate or scale up their production, the way they will look at putting a value on the table is different from any other buyer who comes, who sees a value only in the land and building so that he can lease it to somebody else. So what will happen? Plant and machinery there, land and building may be valued the same way. Plant and machinery for the other person is scrap because he'll give it to somebody else who may not, just because you have certain plant and machinery, your rent will not improve from 2 lakhs to 5 lakhs. Or if you don't have, it will reduce from 5 lakhs to 2 lakhs or 1 lakh. But if I'm a buyer who's in that line only, that plant and machinery is of immense value to me. Because then I'm looking at greenfield or replacement mechanism. Land and building, I may value at the same as others, somewhere near about. I'm not talking about professional valuation. I'm talking about buyer's valuation because a buyer also values your goods. No, he values the asset that is buying, or she buys it. She values it internally to put a resolution amount on the table. So if the buyer is from the same industry, they would always compare two things. One is how much of a coherence or synergy this asset that I'm buying will have with my business. Secondly, how much it costs me to put up a greenfield. Okay, so he puts a value minus how much he needs to put in to revive that plan. And I have advised quite a few buyers as a resolution applicant in their process of plan negotiation with COC. So most of the places, this is the mechanism that we use. Nobody tells us the valuation numbers, and it is not to be legally also. By process also, the RP or anybody else will never reveal the valuations of the company to the buyer. But buyer use its own intelligence and its own agency to fix values based on this thing. So the point of that I'm trying to convey here is the resolution amount that will be offered with the resolution plan can be different based on the buyer, how attractive that buyer finds the specific asset, which sector it is. Certain sectors have high demand, certain sectors have very poor demand. So based on that, the resolution amount will be offered vis-a-vis somebody who's just buying it for land and building, or he's buying only to rent. The higher you get a resolution amount, the lower the haircut would be in general. That's the best linear correlation one can see, otherwise none. In the same case, you will see if it is a different buyer, then he offers a lesser resolution amount, and the creditors suffer a higher haircut. Third point is, which we see quite a bit today, if you publish a Form G and EOI ask for EOI, you'll realize that many of the prospective resolution applicant or people who want to give expression of interest come from a set of buyers who are hunting NCLT ground, fertile ground for value assets. And their determination of value that they give is not based on what is the independent valuation of that. It is As a buyer, what makes sense for me? So as a buyer, if a plant may be valued at 100 crores, it makes sense for me to buy it at 60 crores so that when I pursue my business interest or breaking and selling interest, whatever I want to do with that asset, gives me a 25% or 15% IRR over the next few years that I want to do. His value is pegged at 60. He will not give you 70. So because the buyer who's on a value hunting also increases your haircut because he is going to offer much lower value than what is generally perceived in the market, or that's possible if somebody who is interested in generally strategic buying that asset. And it happens not only in what do you call insolvency cases, it happens in normal day-to-day business mergers and acquisitions also. There are private equities, there are venture capital funds, there are group of investors who are always looking for the value. So again, coming back to what I said, no linear correlation. It depends on the buyer sector and how, what synergies the buyer will have with the asset that is trying to buy. And of course, whether the buyer set, probable buyer sets or probable resolution applicant set as value hunting investors or not. Because the value offered or resolution amount that we put on table is going to be different, and that will determine the haircut. So valuation per se has no linear correlation with haircut. One can always say that, for an RP, to say a plan is compliant, thumb rule, whatever resolution amount that is being offered has to be higher than the liquidation value. But there's no bar on the law. In the law, that a COC cannot approve a plan which is less than liquidation value. COC can very well document his decision and vote on a plan which is less than liquidation value. RP has to bring all the plans on the table or table it in COC and bring out these facts, because he's supposed to do a compliance check vis-a-vis RFRP and legal. Both the compliance check he has to do or she has to do, and then state the same facts that we have done 1, 2, 3, 4, 18 steps here, 18 steps here, or whatever number of steps. Legal compliance, RFRP, so many compliance, liquidation value. Without disclosing the specific liquidation value, you can say it's less than liquidation value, whatever the amount. And let COC decide what they want to do with the plan. They may choose to vote, they may choose to reject. Because it can be done only once, because the Form G cannot be more than twice. A plan cannot be revised also twice. So revision also has to happen. Any EOI scenario has to happen only once. So the point I'm trying to make is, again, in my opinion, I don't see a linear one-to-one correlation between liquidation value and haircut. Haircut is more of a derivative of what is the resolution amount and who that buyer is. Liquidation value can be the same, like explained in the manufacturing case, will remain the same for one entity once it is determined and sealed. But even in that case, you could have two sets of buyer giving you different value. And the haircut will be determined in relation to the resolution amount that is being offered and that is being approved. Now, I think one or two points that I wanted to make before ending this section and moving on to case laws. The measurement of haircut happens against claim admitted. Most of the time, the claims would have interest for a portion of time where everything was closed. The asset was classified NPA 3 years back or 2.5 years back. But banks, while making the claims, or lenders, while making the claim, will, as per the agreement, charge you interest till the commencement of CRP date or till the commencement of liquidation date. If there are penal interest and penalty, they will put on that. Whatever is the agreement terms, I'm not saying they are making a mistake, they should not do it. They will continue because whatever agreement says, they will continue to do that. However, how realistic is it to say when the NPA happened, the total amount, including the interest till the date of NPA was due, was only, say, 200 crore in a case hypothetically. And by the time CRP commencement happened, 5 years elapsed. That 200 crore become 350 crores. Interest, penal interest, everything gets added. So the claim, once the case is admitted, the claim when filed will be 350 crores. Assuming 200 crores is realized by the lenders, they will still say we have realized slightly over 50%, because 350 is my claim, I have realized 200. So it may be 55, 54%. However, in reality, when the asset became bad, you have 200 crores claim. One can argue either way. But I'm saying, looking at the contextual situation, one can say legal right, claims, etc. I'm fine. I'm not disputing that. As I said earlier, I'm not saying that the bankers, what they're doing, or the lenders, what they're doing, the creditors, what they're doing as is incorrect law. But from a different perspective, you look at the day the asset became bad, we knew the stress was there. It can't move ahead. It's closed down. Adding interest, charging penalty is further going to kill it down. It is not a revival. So my opinion is, from a recovery perspective, one should not look at 36% of claim. One should also look at what is the recovery that has been done when the asset became impure, when the asset became bad. What was the due? That will also give an indication as to how much of liability increased and how much of asset value has been lost in the process from NPA to admission. Because in my opinion, maximum deterioration of the quality of asset, value of asset is happening between from this period to this period, which is from the time it is declared NPA to the time it is admitted into insolvency proceeding. कोई बाय बात नहीं होता, and the asset really goes bad. The other thing, especially, of course, which has been reflected by IBBI in the incentive scheme that they have for CRP cases that they have done for RP, only for CRP, is how much is actual resolution amount higher than the liquidation value? Because the whole premise is on revival of stressed asset. So stressed asset has to be sold as stressed asset, and stressed asset valuation is liquidation value. So any which way one looks at it, in my opinion, one has to look at which comparison. Of course, I think I saw the IBBI quarterly report, which says 117 or 170% of the liquidation value is the recovery for all the cases during that period, which is good. So there's something definitely as a class of professionals, there's something definitely being done. There is some effort that is being put where the value realization is more than what is professionally evaluated liquidation value. I think I will, Anjali, let's take a couple of minutes break and then we can start the next section on
Sure, sir.
some of the. Is
Yes,
it okay?
sir. Yes, sir. Fine.
The time we are 3:40. So 10 minutes break. Can we assemble after 10 minutes?
Yes, sir. Sure, sir.
Okay.
तो मैं सिंपल टेक्स्ट मैसेज करती हूँ और चलाने के लिए
Can we start?
Sir, we can start.
Okay. Yeah. So coming to the next segment, judicial pronouncement. In my understanding, I have picked up two key cases, and try to dwell into it in a little bit of detail. And these are not very new cases, they are slightly old cases, 21 of 2021, because these are more with a specific purpose of understanding what were the grounds which were raised, and obviously they relate to haircut by one class or other class of creditors, and they may have very logical reasoning. So the precedent that has been set by the adjudicating authority or the honorable appellate authority or the apex court of the country is that something which we need to understand. Because as I said at the very beginning, haircut is something which will go with every IBC case. I haven't come across any case where there is no haircut. So every creditor faces some or the other haircut. The best position would be secured creditors, where their haircut would be relatively lesser than others. So let's look at the case. I've tried to uh, explain it in a detailed manner, one or two cases that we have taken. So the first case that I want to is Pratap Technocrat Limited, in other words, is Monitoring Committee for Reliance and Fitton Limited. And this has been finally dealt with by Supreme Court, Civil Appeal number 670 of 2021. Let's look at the brief facts of the case. And we will open the judgment and possibly can read out, can do that. The CRP of the corporate debtor was initiated in 2018. Because of litigation, there was a stay which was granted, and that stay was vacated in 2019 May and resumed from that date. Now, the expression of interest was called for or invited somewhere in July, and by 25th November, 4 resolution plans were received. Let's see one. Now, and obviously one of them won. One of them won it. So what does the NCLT order say? We will come to that, but before doing that, I would want to just a moment. And just see, there were 4 resolution plans which were submitted, as I said earlier, and in the 16th meeting, Reliance Digital Platform and Project Service Limited plan was approved by the COC and an application filed. Okay, once the application was filed, what is the order of the? So the NCLT order like any others, which says the application B is allowed, the resolution plan submitted by Reliance Business Services Limited throughout is hereby approved. The distribution of the payment of the financial creditor shall abide by and be subject to order passed in EA 1960 and 3055. Now, and the approval of the resolution plan shall not be construed as waiver of any statutory obligation. The standard term which you will see in most of the detailed order saying that MOA and AOA accordingly, if they need to be amended and filed, they need to be done. Moratorium ceases from that day. The monitoring committee shall supervise implementation and a progress report be filed every quarter. And a standard term of saying this, that the RP has to forward all the relevant records with a copy of order to IBBI, etc. Now, this order got challenged before. There are multiple applications which came. I'm just trying to read out what were the challenges which was before. So the appellants, the challengers, challenge the decision of approval of the plan. The grounds where the appellants were kept unaware of CRP and no details were provided by RP as regards the disposal of the funds towards their claim. One, the claims of the appellant had not received a fair and equitable treatment as envisaged in 30 subsection 2, I think 3 and 4 later, or C and D. The fair market value and the liquidation value of the corporate debtor has not been taken into account, and an amount of 800 crore being the value of certain preference shares did not form a part of the cost of payment to the operational credit. Of course, there were allegations of material irregularity in the accumulation and dispersal of funds that constituted the corpus of corporate debtor. And the appellants were made to suffer a reduction of 90% of their total claims, while substantial claim of nearly 120 crores have not been rejected. Now, NCLAT rejected these appeals. So, what did it say? In dealing with the submission that there was absence of equitable treatment to the operational creditors, NCLAT held that equitable treatment can be claimed only by similarly situated creditors. Operational creditors stand on a different thing as compared to financial creditors. They are entitled to receive payment not less than the liquidation value, which does not apply to financial creditor because this order is prior to August 2019. That's why. Because in that, the 6th August, if I recall correctly, the regulation which was brought in the amendment, which said dissenting creditors also, dissenting financial creditor also has to be paid liquidation value. That's one. I'm just reading out for clarity and better understanding of the group from the order, different specific points. Please bear with me as I scroll through it. The second aspect is liquidation value. On this, it has been filed that the liquidation value due to the unsecured operational creditors would remain nil in all scenarios, including if the corpus of 800 crore is separately considered.
Sir, can you make the PPT on full PPT mode? It is not readable.
No. I'm reading from the order, sir. So please bear with me. PPT, I will bring it to full mode, because this section that I'm reading, I would have had to make 30 of them separately to one order. I'm just open the order in PDF and reading from there.
Okay. Sure.
And the third point, that when I spoke about challenges before NCLAT, relates to the impact of exclusion, where they said it was excluded. So it says, if any member has been excluded, or here the third aspect related to the order of NCLT in Doha Bank proceeding, and which is moved by Doha Bank for removal of certain financial creditors from CNC, has no bearing on the status of the approval of the resolution plan, for the reason that it has received a unanimous approval from the 100% voting share. So the dictum that if there is a change in COC, the decision taken by them does not get invalidated. Of course, courts have given a different view in case if the COC was illegally constituted, which means certain related parties having minor or major voting share were allowed to remain as members of the committee with full voting right. Then there have been judgment in cab industry, recently Dhyan Jyoti, Sugars, and one or two more, if I recall, where it has clearly said the constitution of the COC was illegal, so decision taken by that COC can be invalidated. So it says it does not make any difference. And what it says is the resolution plan was approved by the COC in compliance with provisions of IBC. The jurisdiction of adjudicating authority under section 31(1) is to determine whether the resolution plan as approved by COC complies with the requirement of section 30 subsection 2. NCLT is within its jurisdiction to approve a resolution plan which is according to the IBC. There is no equity-based jurisdiction with NCLT under the provisions of IBC. So whether a haircut of 90% or not, if the plan was approved by COC with requisite percentage, then it is valid. And NCLT or NCLAT for that matter do not have the power. Okay, so I'm just moving on to. So some of them I've just listed down. That's why I read the whole thing, challenges before NCLAT. One of the points of challenge was haircut, which I read, and which is quoted here. The appellant were made to suffer a reduction of 20%. Now, what is the final order or observation? It says the function of the adjudicating authority under section is to determine whether the resolution plan as approved by COC in which section 34 meets the requirement of section 30 subsection 2. If the A is satisfied, then it's a by order approved plan, and which will be binding on all the stakeholders, including which have been. Now, in this background, when appeal went to Apex Court, what is the final observation by the Apex Court? And this particular judgment was set a precedent, has set a precedent in many cases where later challenges were made on just an equitable grounds or haircut grounds. What does the apex court say? And I have the whole judgment, I put it in inverted comma. In the present case, the resolution plan has been duly approved by a requisite majority of the COC in conformity with section 30 subsection. Whether or not some of the financial creditors were required to be excluded from the COC is of no consequence. Once the plan is approved by a majority, here it says 100% voting share of the COC, the jurisdiction of the adjudicating authority was confined by the provision of section 30 subsection 1 to determining whether the requirement of section 30 subsection 2 have been fulfilled in the plan as approved by COC. As such, once the requirement of the statute had been duly fulfilled, the decision of the adjudicating authority and the appellate authority are in conformity with law. For the above reasons, we find no merit in the appeal. Appeal should be according stand. So this was the apex court judgment. Another case that I've taken is, I'll just read that, Air Force Group Insurance Society versus Subramanya Kumar, Administrator, DHFL, and of course the respondent of the COC and Pyramid Housing Society. Those are in flat order. Now here, I would like to read some of the things which I've been able to put it here. The appellant is RB Group Insurance Society, which says they should be treated on par with secured creditors since they provide insurance cover for the defense personnel, because no civil insurance companies are providing any kind of insurance risks or insurance cover to the defense personnel due to the potential war risk. They are providing this, which is a very important thing, and NCLT found it appropriate and requested the committee of creditor to reconsider and repay the entire admitted claim without any haircut, thereby expressing its deep concern, gratitude, and respect to the army personnel and the thousands of families, widow children that can be saved from making such payment. So this was something which, in fact, I remember in one of my cases, which I was also associated with, the resolution applicant had given a small amount of 5-10 lakh rupees towards the distribution amount or resolution amount of employees. And the court, while hearing the arguments on approval of resolution plan, made a request to the applicant counsel, since there are no employees currently available, there are only few which were there before or at the time of commencement. Why didn't you look at, and they haven't got their salaries for so many years, why don't you look at whatever you're paying, make it double, make it instead of 5 or 10 lakhs, make it 20 lakhs, which the applicant agreed. And it was as a request, it was not as a direction, because if had it been as a direction, it would have been challenged, because they don't have power to change your resolution amount. The court tribunal doesn't have power, either tribunal or the appellate tribunal. But since the RA agreed, the whole incident was, the order, it was recorded the same way, that a request was made by this thing, and the SRA agreed to accede to the request, and it was so and so forth. Here also, NCLT made a request to the committee of creditors. Let's see what the order is. Finally, the order NCLAT which gave, it says that A has limited jurisdiction in the matter of approval of a resolution plan, which is well defined and circumscribed by section 30, subsection 2 and 31 of the code, read with the parameters delineated by this code in the decision about work. The jurisdiction of the appellate authority is also circumscribed by the limited grounds of appeal provided in section 51 of the code. Therefore, even if the contribution of hard-earned money by employees of Air Force is invested in FDs, FSP, that is financial service provider, that is DHFL, and RBI as a regulator has initiated CRP under the INB code, then the allocation of recoveries to the creditors shall be as per approved resolution plan only. Accordingly, NCLT or NCLAT cannot exercise equity jurisdiction to prevail over the commercial wisdom exercised by the creditor. The order dated 7 June passed by the NCLT needs no interference. Accordingly, this is dispersed out. So the challenge of haircuts and an emotional patent-free challenge to make the haircut be zero because of the background and the kind of work the appellant or claimant was doing, unfortunately could not pass through the judicial scrutiny, and they said this haircut will have to go. And this is what I've been saying right from the beginning, haircuts will happen in every case. Challenging haircut under the provisions of IBC becomes difficult until unless there's something wrong which has been done, which is not as per regulation or this not, following or not in line with the provisions of the code. In that case, it can be very well challenged and won against. However, if the due process has been followed, the chances are all these agreements have kind of become a set. The next case law that I'm taking is different. Here, haircut is one problem, but more than that, there is certain amount which is being paid to somebody who did not submit his claim. Again, the matter of on one side haircut, other side, and this is one of the cases where me and my team or my IP was associated as advisor to the RP. So we do understand the nuances of this case slightly better. So here, just a moment. Again, going to the normal mode and opening the PDF, maybe let me try and share the PDF with you. So this is a flat case, and there are multiple, applications which have been filed against approval of the plan. So I will not go through that. I will come to relevant portions where the challenge has been, and then we will read. See, one of the challenges that is put here is Gamada is Greater Mohali Administrative Development Authority, Greater Mohali Area Development Authority, to the best of my understanding this. So, what had happened is Gamada did not submit its claim in this case. They didn't even bother, like many other land owning authorities or regulators in real estate case. And the resolution plan specifically, which the order also deal with, that we will read when we go to the order. What is being challenged here that the resolution applicant, for the purpose of distribution of the money, it is giving 100% of the dues that was there as per the books to Gamada, whereby no claim has been made. And income tax authority, which is claiming, is given only 25% of due. So look at the claims. One is haircut, one is non-claimant, third is parity between in the same class. Now, so this is something which I wanted to show. Let's see. Just looking more, which is written in the order. So okay. So what is the order that is passed by the Honorable Appellate Tribunal? What it says is from the aforenoted judgment, it is clear that so long as the provisions of the code and the regulations have been met, it is the commercial wisdom of requisite majority of the COC, which is to negotiate and accept the resolution plan, which may involve differential payment to different classes of creditor, together with negotiating with a prospective resolution applicant for better or different terms, which may also involve differences in amounts of distribution between the different classes of creditors. It is observed by the Honorable Ethics Court that the equity principle cannot be stretched to treating unequal equality, as they will destroy the very objective of the court, while the adjudicating authority cannot interfere on merits with the commercial decision taken by the COC. Judicial review available is to see that the COC has taken into account the fact that the corporate debtor needs to be kept going as a going concern, during the insolvency resolution process that it needs to maximize the value of its assets and the interest of all stakeholders. Judicial review available is to see that the COC is taken into account the fact that the corporate debtor needs to be kept and maximization of the value of the asset is taking place in interest of all the stakeholders. Next point. In the instant case, what has to be kept in mind is that the corporate debtor is a real estate company involved in construction of housing and commercial units, and the land on which the construction is to be completed belongs to Gamada. As the nature of the activity of the corporate debtor is dependent on the land owned by Gamada, the commercial decision taken by the COC to make a provision in the resolution plan with respect to the statutory due owed to Gamada cannot be faulted with. Though Gamada has failed to make the requisite claim as provided for under the code, but has been in communication with the RP. Though we do not appreciate the act of Gamada not having filed their claim, the fact remains that the real estate project is being constructed on Gamada's land, and all approvals, permits, and licenses involve Gamada, which is a secure creditor. Further, the nature of business and the ground realities were kept in mind by the COC before taking the commercial decision. In approval of the resolution plan, the COC takes business decision based on the ground realities by the majority of all stakeholders, including the sentence. So, all the disputes, etc., is, in terms of Gamada, haircut, non-claimant, everything is being addressed here. And the subsequent para says, keeping in view the peculiar facts of the instant case that the resolution plan was approved by the COC way back in 2019, and the adjudicating authority has approved the plan on 1/6/2021 after a period of 2 years, and the plan has already been implemented. We do not see it as a fit case to set the clock back, specifically keeping in view the ratio of the Honorable Supreme Court in judgments that certain judgments reported in that particular order. It is hoped that the IBBI government may take effective steps to make necessary amendments, frame regulations to protect the class of financial creditors through home buyers from imposition of any haircut, and likewise take essential measures to safeguard the interests of operational creditors in the structure of resolution plan. And these appeals were dismissed accordingly. Now, two key things that the Honorable Court here, Appellate Tribunal, has pointed out. It says the government, it directs the government and IBBI to take effective steps to make necessary amendment frame regulation to protect the class of financial creditor or home buyers from imposition of any haircut. Though a very laudable thought by my lords, in reality, not possible by the trade practice. Maybe in future possible, but in near future, immediate or in 1 year's time, where the old cases will be coming, next to impossible to ensure that there is no haircut. Operational creditor, I think there have been some amendments, some changes in the regulations, which aids a little. There's nothing much that can be done. the way the waterfall mechanism is under 53, and when you read 30 subsection 2 with 53, there's nothing much you can do on the operational creditors plan and final realization. I think that would need an amendment. There is something in the offing, but we don't know exactly how it will come and what shape IBBI is giving, or so we'll have to wait for that. Now, the related point which my lords have raised here, I just wanted to clarify that to my friends and learned members here, members of IBBI. Haircut to home buyers, it does not mean they'll get a smaller unit if they book 1,000 square feet, they'll get 800 square foot or 500. No, it does not mean that. What it means, there are two ways which will happen. In a real estate company, home buyers or unit buyers are the only creditors which further pay. Most of the time, as long as they are classified as unit holders, their claims is admitted under the category class of creditors. In my experience and my firm, including myself, we have done 17, 18 real estate cases so far. We haven't seen even a single case where any money is paid to a unit holder, even though they are financial creditors. What happens if you look at the builder buyer agreement in case of home buyer? Most of the running cases are old cases, prior RERA and things like that. And even after RERA, initial stages of RERA, most of the builder buyer agreement or flat buyer agreements, they used to be one-sided. There would be no refund or any interest on refund clause. There would be compensation, 2 rupees, 5 rupees, 7.5 rupees, 8 rupees per SFT per month, which is chicken feed that they are trying to get, compared to what they charge, the builders charge from the home buyer. 10%, 20%, 20%, all kinds of 18% for delayed payment. So as a regulation, a part of the process, what you do is you verify the principal amount paid by each unit holder and add 8% simple interest to the amount from the date of payment. Any other claim other than home buyer, where there is an agreement, financial creditors, let's take it. Interest is charged, interest is part of the claim. And the claim, any payout is judged against that claim and not against the original value. Here, because of the nature of practice, as per law, 8% is added to give them the right kind of a voting share. Otherwise, their share may suffer. Because most of the real estate cases you'll find they have been closed for 2 years, 3 years, 4 years, 10 years, 8 years is common. Now, every other financial creditor, as per the agreement, charges interest, their realization is pegged against, or their haircut is pegged against the total claim, including interest, penalty, etc. What happens to the home buyer, unit holder? No. The interest component of it certainly a haircut, either as an opportunity cost or as a satisfaction of claim. Because even if a resolution plan is given, usually it says that with this, we will build and hand over the units to each unit holder. That would take care of satisfaction of only principal. So no other claims, compensation, etc. can be raised. once voted upon. Which means if you look at their claim and what is being satisfied, because there's no money being paid to home buyers, it's only units most of the time that they get, and which is again satisfaction of principle. So whether you like it or not, or whatever you do, by the practice and the law point that is there, the interest that is there in part of their voting share or in their claim, which is added, what they get delivered is only the principal. So interest is always a haircut to the home buyer. The second kind of haircut, which may happen in many projects which are in deficit, which means the cost to construct is more than the amount that is recoverable from the unit holders, the amount that will get recovered from units unsold, and any left FSI that can be exploited. If these three assets put together are less than the cost of construction, then it's a deficit problem. In that case, I know of 2-3 cases where the home buyers have decided to pay more than the BGA rate. If they had bought flats at say 5,500 rupees per SFT, they are willing to pay 1,500 rupees more per SFT. So 5,500 plus another 1,500, which brings the number to 7,000. Instead of 5,500, they pay 7,000 rupees per SFT to get there. So this 1,500 of enhanced unit cost that they're paying is also a haircut to them. I thought since the previous, this case law specifically spoke about the honorable judge specifically giving direction to ensure that there's no haircut to the home buyers and holders. But it's important for me to clarify this point as a practitioner, in reality, what happens. I am taking now few cases either for your reading or I have just taken this case because there is too much of press and hangama which happened. So I've just picked up from one of the articles, this one, where somebody is writing AI with, I think, All India Banking Employees Association, or somebody who wrote to RBI. So are you okay with 94% haircut for banks in Shiva Industries one-time settlement? I think this had created a lot of furor, and it hogged a fair amount of press headlines. However, after that, it died down. I just wanted to share with you what happened to this case. This case went to Supreme Court. NCLT, in fact, the background of this case was that while the CRP commenced and the process was going on, the owners came and made a settlement offer. COC voted on it. And then, the time period was over. Liquidation was moved. CRP withdrawal application was dismissed. NCLAT upheld the dismissal. And so on and so forth. So it went to Supreme Court. What does the Honorable Apex Court says there? Sorry. And this happened in 22, whereas it was one of the initial ones, 18-19 cases. I've just captured the headline from IBC law where I pulled out this. It said Supreme Court allowed the settlement plan of promoter of Shiva Industries at liquidation stage. What does the order say? It is thus clear that the decision of the COC was taken after the members of the COC had due deliberation to consider the pros and cons of the settlement plan and took a decision exercising their commercial wisdom. We are therefore of the considered view that neither the learned NCLT nor the learned NCLAT were justified in not giving due weightage to the commercial wisdom of COC. And the settlement was allowed at whatever amount we saw in that after a 94%. Since this was one of the first case which was raked up very highly in the press, I thought this I'll take you and share with my learned friends here the fate of this case and what is judgment per se the order says. Very clear. I would also like to, suggest some 2-3 cases if one wants to see. They're very popular, famous cases. One can read to, I'm not cutting short, I'm just using the slide for recommendation for that, because if we start discussing all this, we'll not have enough time. So I'm recommending subsequent cases, which one has to look at. So what I'm recommending is haircuts. Look at Videocon group case, 99.2% haircut. Interesting one, just see. It will also show you how the lending has been done in this case. Alok Industry, another good case. Monet and DHFL also. And DHFL, if you read through and the read analysis, not only order, but read analysis from outside, you'll realize the value could have been a little better, could have been much more. And one case one should definitely look at ILNFS, which is one of the largest cases which went into IBC process, almost 100,000, 1 lakh crore worth of that. And a committee was formed under Mr. Vivek Kotak's chairmanship to oversee the whole process. And it has been done, I think that has been done quite well, where the haircut came to only 40%. Looking at the complexity, they had 296, if I remember correctly, subsidiaries. I mean, funds flew from here, there, so many things. Extremely complex case, but in my personal opinion, this is one of the cases which has been done very well. And as practitioner of this insolvency, we should look at this case and read about it. It'll give us some insight into how it was managed. I think beyond that, I would like to conclude in simple terms. And I repeat what I want to say. Haircut is positive. For insolvency practitioner, haircut is positive because without which it's a reality. Stress asset always go for discount. It's a reality. We can't shy away from it. So I look at it as a positive, even though the sequence is up and down, but I want to emphasize that as a much higher point. It's a positive as it offers resolution. Maybe 1 in 3. 2, because of the older cases and significant deterioration of asset quality and value. 2 in 3, I mean, 2 out of 3 cases goes for liquidation. But at least 1 in 3 is getting resolved. We are able to protect capital, we are able to protect employment, we are able to aid to the economy. So haircut is positive because without haircut, this is not possible. They would remain dead. Liquidation, recovery will happen. But that, whatever asset went into it, 80% of the time is vanished now. The going concern sale happens only in 10% cases, to the best of my knowledge.
Sir, when
The other,
haircut is
1 minute.
bordering on 90%, how can you say it is positive?
I'll come to the Q&A, sir. Just give me 2 minutes. The other point that I wanted to say, haircut would be lower if the asset is brought to insolvency as soon as they are classified. The sooner, and of course, that club with early admission of insolvency cases will also help to reduce the final haircut. I think I don't have anything beyond that. Yeah. Yes, sir. We can take question answers. So.
Sir, what I asked was, I accept that haircut is a reality under IBC, but when you say it is positive, I don't think when it is bordering above 90%, it is really positive, or even 80%. How can you say it is positive?
Okay. So the perspective from where I come from, sir, if the asset were not in IBC, first of all, are you a banker, sir? Mr. Karakan?
Yes, I am a banker.
Excellent, sir. So, I mean, that helps me to explain. Sir, as a banker, you would try SARFAESI and other means of recovery, which is faster, without aid of the court, to get your asset, I mean, get your value recovery. If you are not secure, you will try and, pillion ride secured bank or secured lender with them and see if you can get something in recovery after their dues are satisfied. But when none of these are working, you take it to IBC. Sometimes it may so happen you may be under the process, but an operational creditor sends you to IBC. But recovery under SARFAESI and IBC, as far as the percentage recovery or the haircut, there is not much of a difference. IBC is slightly better. SARFAESI gives you 28%, IBC gives up to 36%. On an average, that's what is seen. If IBC is not there, most of these stress assets, you would recover 60% of the cases recovery will happen. Because from my experience, 1 in 4, 1 in 5 cases we have seen, in spite of repeated auction, under SARFAESI, nothing has happened. No recovery for the bank in those cases, sir. No recovery.
Yeah, I agree. There are difficult SARFAESI cases.
So
Yeah.
that is where I'm coming from, sir. It would have gone waste. Now I'm coming from a positive perspective. No haircut is good, but I don't think as insolvency professional we created that situation. It happened. It's a commerce cycle. It has happened. All I'm saying is, by putting in effort as IBC professional for assets, like I said, the sugar asset, 5 times it had happened, auction, nothing happened. And then it came to IBC, and IBC professional, whatever hard work they had to do, they were able to find somebody. We were able to, work with them, and resolution happened. And in fact, actual due when the NPA happened, the due was only 180 crores, if I recall correctly. And recovery, almost 25% near about that, than that happened. The point I'm trying to make, even though the haircut here is 94% or 80%, but still 2 things are happening, sir. Recovery, whichever means they would have tried, they would have got similar recovery, the lenders. As a banker, you also would have tried. If you had been successful under SARFAESI, you would have got 28%, 20%, 10%, depending on the quality of the asset. Would have got. But here, in addition to recovery, lenders getting their money. But what is happening is 1 in 5 case, it is getting revived. The industry is starting back. It is restarted, the plant is restarted. There are a few hundred people which get employment. There are farmers which are able to sell their sugar cane. So it kind of, you know, adds back to the growth of economy. That is why it is positive. On a single line challenge, if you ask me, 94%, I'd say 94% is gone from the economy. But I'm saying having as a as an insolvency professional, where you have no hand in that 94%, you get to work when it has already reached 90% or something like that. So you have to look at, if you are able to resolve, then it's a positive. Let haircut be there, at least something is happening. Some money is going back to the lenders and the company getting revived. The capital that was initially sunk, maybe 100 crores, that is utilized, that's not gone waste. People are getting employment. Further ancillary units, townships, other things get a revival in that area. It's not a small shop, no? An industry which is open, it gives employment indirectly to a few thousand people at least, if not few 10,000s, at least few thousand, 8,000, 9,000 people get employment, either through business, either through something, contract labor, security guards, labor to clean the plant, and all those. That is much larger in number. So from that perspective, I'm saying.
Sir, when you bring the issue of employment, I doubt. I accept your point, but I doubt in really it's really true in generally in all cases, because if I say one of the biggest cases in the recently concluded was the Jet Airways. Jet Airways has thousands of employees, and finally, when the IBC concluded very fast. But I don't think hardly even 10% of the employees got back the job.
Very, very much agree with you, sir. I think my perspective is here different. Once Jet Air was closed, it came to IBC after closure. Once it was closed, all the thousands of employees that it had, they had lost the job. Any which way. They had lost the job. If tomorrow revival happens, because the private equity player, I think it is stuck on that 250 crores additional payment that is to be done towards PF and gratuity dues. So if they pay, they will revive the company, revive the airline. They may not be able to employ the full, say, 5,000 or 6,000 people that were there directly, indirectly, with Jet Airways, ground handling, pilots, blah, blah, blah. But now whole 5,000-6,000 people to become employed, if you may have found alternate employment. So among the unemployed ones, even if 1,000 get employment, that's good, sir. That is where I'm talking about revival. At least they will be get 1,000 people will get a job, 500 people will get a job. That is more important. Otherwise, I don't think other airlines have absorbed, especially the ground engineers, etc. Not even 5% have got jobs. That's what I've heard. I haven't read anywhere. I've heard. I don't think, no. I don't think I've heard it from Ashish, who was the RP here, but I've heard from somebody else. I can't quote it. No. I think.
I know Jet Airways a little more closer, but I'm not bringing it, debating it.
No, I can't speak about things which are not in public realm, sir.
Sir, I want to raise one more thing actually. In the case of housing projects, actually, see, when it goes to IBC, the people who have taken loans from banks and FIs, okay, they continue to pay the loans and they are at the risk of getting the property. How do you deal with the situation?
Very valid question, sir. Let me divide it in two parts. So whenever you are dealing with a real estate project where the unit holders buy, see the nature of asset in a real estate is that this is a one-time asset. A company is formed, land is there, you build the building, and after that, the ownership is transferred to unit holders, either through
Yes,
lease instrument or sublease instrument or freehold instrument, whichever way it is transferred.
right,
The
right.
company, the CD does not have any more asset left except few plant and machinery bits which was used in construction. So resolution applicant coming from a housing project will not put in more money because he will not come and put in 300 crores to be returned back to the creditors. No way. So even the traditional wisdom that the courts use, that if the value resolution plan value is less than liquidation value, throw it out. What is the commitment that the resolution applicant is making? The resolution applicant in housing project comes only way to make things happen is to complete the project. By completing the project, the resolution applicant will make money in the construction. There is no other avenue for him to make money. He is lucky if he has got unsold inventory, which he takes over and sells it. He is more lucky in one odd project, which may be exception, where there is some commercial FAR left to be exploited, which normally doesn't happen. Normally, on 95% cases, the builder would have exploited everything and he would have sold everything, taken money against it. Now, coming to your answer, having given this background, coming to your question, sir, if I am RP or if I'm advisor to RP as a process advisor, my suggestion to every home buyer case is look for a resolution to build the project. Because if you don't build, then the home buyers lose everything. The money that they have paid, nobody comes and pays you a single penny. Your bank will be after you because it's a privity of contract. It's a borrower lender contract between the bank and the individual who's borrowed money. Even though there may be a tripartite agreement with the builder, but builder is not in existence. Banks will run after you. They will file cases, they will do 138, all that. Of course, uh, there is a case, Delhi High Court has put stay to all DRT and check bounce 138 case, stay on that wherever the projects are in limbo and they are into CRP process. So they have put no more coercive action against borrower, and people can use that case. I think it is Hridayanath Pathak versus Shubkamna Buildtech Private Limited. I think that's the one. And then many more cases on the line. That was an issue one, if I remember correctly. So as an RP, earnest effort should be to resolve, which many a times would mean that unit holder who have bought flats at 3,500 rupees per SFT, and because of siphoning of money by the promoters, there is lack of money, and they may have to require to be paid 500 rupees more. I would convince the home buyer, have a long town hall meeting along with the AR, because AR is a representative class of creditors. I would request the AR to call for a town hall meeting of 100, 200, 300, whatever number of home buyers are interested in coming, answer their questions and convince them that this is the best solution. So suppose you have bought a flat, 1,000 square feet flat at 3,500 rupees, which means total payables 35 lakhs. Out of that, you have paid 25 lakhs. 500 more would mean instead of 35 lakhs, you'll get the flat at 40 lakhs. Now, if you don't do anything and it goes into liquidation, land is invariably owned by the land authority in most of the cases, or they have the charge, or project banker will have our charge. So liquidation value of such project building, nobody gives any value much in liquidation. It is the land value. They will take away. What will come to home buyers is not even 5%, 2%, 1% recovery. So the 20 lakhs that you've paid is gone down the drain. Now to save that 20 lakh, you pay that 5 lakh more. There is always a possibility when the project is ready, the market value may be instead of 3,500, maybe 4,500. It's a very natural phenomenon when a project starts into slightly suburbs, side area, where you are able to get at 3,500, and most of the end users, home buyer, buy into such projects only. And once that project and nearby projects start getting developed and people move and start living, it's a natural progression. The rate improves by few hundred, few thousand, depending on the area. So even if you want to sell, you're not at loss. You may not be able to recover all your interest that you paid or that you've lost, but at least your principal you will not lose. Worst case scenario, even if it remains at 3,500, you lost only 5 lakhs, not lost 20 lakhs. So that is the way I look at it. There is no other resolution to the best of my mind or any other idea that comes to my mind that you can find it.
Yes, sir. I have come across in cases people have paid the full money, and as you said, the financial institution will have first charge on the property because he has financed the construction, and the home buyers are really in a difficult position. Despite so many changes have happened in these kind of cases, I think we still should have a relook on these kind of cases where the individual home buyers are really in a poor position.
In fact, sir, just the academic thought, it has gone from my side and my senior partner, another partner. We think the home buyer should be made as a secured creditor. And we have limited grounds to support it. Like if you look at identification of security, it is there because a unit is identified.
Yes, yes.
Is it specific? It is towards that, and it is specified to a particular borrower or particular lender. All the three are there. The unit is separately identified. It is very specific, and its specificity or this specific nature is against a particular unit holder.
Exactly, sir.
And these are the requirements that you see when you register, when you look at a security interest. However, the counter argument that comes here is Transfer of Property Act. Under RERA IBC, you can do the argument that I did. But under Transfer of Property Act, it will say, how can you create a charge against an asset? How can you mortgage an asset which is not in existence? So, but still, our input to relevant authorities or to relevant people at whatever time of discussion is that one should look at making home buyers as a secure creditor, but I assume there are a lot of challenges to do that. Any other question? I think
Thank you, sir. Yeah.
Thank you, sir. Any other question, or we can close? Anjali, check if there are questions in the chat box or QA box.
There are no questions in the chat box.
Good. So thank you so much for giving me your valuable time and paying attention.
Anyone you want to ask questions?
I think then let's close this scenario. Thank you very much. Thank you, Anjali.
Thank you very much, sir. The session was very informative.
Thank you.
Please share the PPTs of yesterday and today.
Sure, it will be shared by tomorrow.
Okay, thank you so much.